Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hey, everybody. I'm Don McDonald. Welcome to another exciting edition of Talking Real Money, the podcast. This would be the end of the week podcast, which means I'm recording this on Friday, the 21st of January. And given that it is the end of the week podcast, it has become a tradition now for it to be all about, or mostly about, your questions and my answers to those questions. So that's what we're going to do again, because we still have a lot of questions that need answers. And those came in, by the way, a couple of ways. You can ask questions several ways. Most common is to call 855-935-TALK, and that'll get you through to our live Saturday show, which airs from 3 to 5 Eastern, noon to 2 Pacific. But it will also take you to our computerized answering doohickey, and you can record your question. So record your questions, and then I'll answer them generally on Fridays during the week sometime. But most of the time it's on Friday. The other way to send in a question, you can speak them like you would a voicemail by going to talkingrealmoney.com and just use the microphone on your computer. And by now, you should have a decent microphone on your computer. You really should, because we do so much communicating now on our computers. You can also type your questions at talkingrealmoney.com. And if you have a bigger, broader, really long question, well, then go to vestory.com. That's our investment advisory firm, and make an appointment with one of our advisors, because we will give you free time to help you solve a problem or get started. And we don't pitch you anything, no high-pressure sales pitch, no obligation, no cost, just some free time. So there you go. I think I told you how to do it. Oh, one other thing I did want to mention. Now, bear in mind, this is around lunchtime on the East Coast on Friday when I'm recording this. And so far this week, we try not to pay any attention to the stock market, right? Right? Because it doesn't always go up. I know we wish it would, but that is not a reasonable wish. Stock market doesn't always go up. It goes down sometimes. Now, the good news is it has in the past gone up more than it has in the past gone down. So one would expect that any decline in the value of the market will eventually, we don't know when eventually is, turn around. This week, yes, if you're just in the S&P 500, which we think is foolish, you would have lost, I don't know how the day is going to end, but around 5% of your portfolio, a little less. If you were globally diversified just in equities, you'd be down about 3%. So, it's not been a great week, but bear in mind, it's part of the price you pay for the outsized returns that stocks have delivered over the course of decades, or a century even, at least that we can track. Let's get to some questions. Let's see. The first one came in via Talking Real Money. This was recorded on a microphone at the talkingrealmoney.com contact page. And you'll hear it sounds really good.
Hey guys, I absolutely love the show. This is Brian calling in. I've been listening every day for probably almost a year now. So I'm actually calling because I was hanging out with a friend the other day, and the topic of investing came up. And my buddy, he's 37. We're hanging out, and he goes, "You know what? You sound like you know a lot. I got some money just sitting there in a bank account, and I want to start investing it. I want you to help me." And he's telling me this, and I'm like, okay. Well, so, I told him to take the risk quiz, first of all. I sent it to him, and I told him I'd come over and help him set up something basic just to get started. And what I'm thinking for him, since he expressed the desire to want to start making the distributions around age 59, which for him would be, I guess, in 22 years since he's 37. So he's got 22 years. So I said, to myself, I said, what if we set him up just something simple, since he's never done this before, but I also want him to be tilted towards something a little more profitable. So I'm thinking I want to put him 80% in VT, 20% in AVUV. And I want to tell him, yo, when you turn 50, go over to Talking Real Money and talk with Vestory. Because I know at age 50, he's going to want to start, probably gliding towards some more bonds in that portfolio. I don't want to set him up with a target date fund because I'm going to set him up with a Roth and with a taxable. And I know holding that target date fund and a taxable might not be the right move. And plus, I want him to be all at M1 since it's such an easy place to rebalance and stay, within your allocation with the pie that they have. So I want him to just be in VT and AVUV 80-20. And then I think number 3, it'd be great for him to get an advisor when he turns 50 anyway and have someone else help glide him down into his ultimate allocation, which might be 60-40, stocks and bonds. So, yeah, just to recap, I'm going to get him in 80% VT, 20% AVUV, tell him in 13 years when he turns 50 to go talk with you guys and start working with an advisor so he can start getting towards his ultimate, allocation when he turns 59. But those are the training wheels I want to get him going and, have him start developing the habit of investing. I want him to do $10,000 a year to start and increase that by 3%. He makes good money, so I think he can develop that habit pretty easily. I guess, anything you notice that I'm doing wrong, please just point out, because it's kind of a big responsibility advising your buddy on that. But I guess my actual question is that I guess I feel a little nervous about putting him in 20% AVUV and having that not be globally diversified small value. Should I be doing 10% AVUV, maybe 5% AVDV, or 6% AVDV and 4%, I don't know, AVEM or something like that? I don't know. Just asking about the small value, if that should just be all U.S. small value I put him in, so it's a simple 2-fund portfolio, or should I be doing a little more complicated so he's got more global diversification in that small value portion? Thanks, guys. I really do appreciate it.
Okay, Brian, you just take over the show. Really, I'm going to take the rest of the day off. You're fine. You should just be giving out the advice. It's good advice. I mean, really, keeping it simple is not a bad idea. If you want to help him make it a little bit more complicated, there is a way. AVUV is the small cap value ETF from Avantis. But Avantis also has an ETF that's small cap international value, and that's AVDV. So you could do 10% in AVUV, 10% in AVDV, and 80% in VT, which will give you an aggressive portfolio, but not horribly aggressive. It's aggressive. Again, this is the kind of portfolio that in the past would have declined by about 50%. But your friend is doing something that should ameliorate that concern. And that is, as a matter of fact, he should be excited about buying right now because prices are down a little bit. He's getting more for less. If they go down more next year, great. Then he's getting even more for less. Because it's better that the market go down when you're accumulating. But it's going to go down at some point anyway. As long as he's good with that, I think that this makes sense. This makes great sense for somebody with a 20-year horizon. 20-year, hopefully, plus horizon. 59. It's funny when I hear people in their 30s saying they're going to retire at 59. I remember thinking something very, very similar. And now I'm several years past 59, and it's like, what the heck would I do if I was retired? I can't think of anything that'd be that fun. So he could change his mind. Conservatively, I would say he could average about 7% per year, given the fact that a portfolio like this in the past would have averaged 10 or more. So let's say conservatively 7. That puts him, $500,000+ bucks at age 59. So Pretty good. And I also agree with you on the advisor thing. It's something you tend to need when not just the portfolio needs to go into a withdrawal phase, when you need to start glide pathing down, but because life gets more complicated when you have a larger portfolio, you have other sources of income, you've got estate planning issues, you got tax issues. There just needs to be more guidance as our portfolios get larger and we get older. So, yeah, I think it makes sense down the road. It doesn't make sense right now. It's not cost effective. And he's in accumulation phase right now, which is the easiest part. Yeah, easy. As long as you have the discipline to continue to accumulate. But very, very good advice, Brian. Thank you so much for sharing it for others to listen. You did well. Thanks. Our phone number is 855-935-TALK, 855-935-8255. And our next question does, in fact, come in via the phone line.
Hi, good morning. My name is Maggie. I have a question regarding my daughter's Roth IRA account. I set up the Roth IRA, and I have a total stock market, VTSAX, and international growth, VWIGX. But I saw you would recommend the total international index fund. And the VWIGX international growth fund, it didn't have a good performance last year, 2021. So I'm just wondering, should I switch that VWIGX to the total international index fund? Could you give me guidance? Thank you very much for your show. Bye-bye.
Thank you, Maggie. Thanks for the call. Okay. Let's just, what you have right now are Vanguard mutual funds. You have the International Growth Fund, which is not one of our favorites. It is not an index fund. It is an actively managed fund. We're not big fans of actively managed. Now, that doesn't mean that it's bad or good, either one, but it does mean it's actively managed, which means you're paying more. The expense ratio is about 10 times higher than a typical Vanguard index fund. So that's one of the reasons we wouldn't like it. Now, I don't want you to get in the mindset of following performance. International markets did not do as well last year as the U.S. markets did. That's part of the reason why you own international in your portfolio. So, therefore, I would probably have everything in something like VT, because remember, VTSAX, the Vanguard Total Stock Market Index Fund, is also just the U.S. So, yeah, it would have done better last year, but what about in years when the U.S. doesn't do as well? I'll give you an example. So far this week, when I recorded this as of Friday around just afternoon, if you owned a globally diversified portfolio this week, you would have lost about 3%. If you'd owned just the S&P 500, which is the U.S. big cap funds, you would have lost almost 5%. So we may be seeing it. We don't know. That's why we diversify. I would suggest that your daughter would be far better off in VT, the Vanguard Total World Stock Index ETF, which has very, very low cost and easy to get, because you're not going to be second guessing the two markets. You're just going to look at that fund and go, oh, okay, that fund. It's really broadly diversified. I think that would be a better idea than trying to go international U.S. and then down the road go, well, the U.S. beat the international. Maybe I should get out of that. No, I think you should be in a well-diversified fund right now for her probably, and VT's very likely a good bet. Maggie, thank you for the call. We appreciate it very, very much. And let's do another one that came in from TalkingRealMoney.com.
Tom and Don, this is Gates from Alabama, and I really appreciate your show. I look forward to it. I laugh at it, but I learn a lot from it, and it's truly appreciated. I appreciate the fact that they're very regular podcasts, and they're not hour long, and you learn a lot in a short period of time. You've been really helpful in the past on questions regarding Roth conversions. And today is just a detailed question. I have the majority of our taxable accounts in Vanguard. I'd like to begin to put money into their small cap value offerings. And I'm comparing their Vanguard Small Cap Value Index Fund, VSIAX, with their Small Cap Value ETF, VBR. Both have 7 basis points as expense ratios. Both of them appear to only provide or distribute quarterly dividends. The mutual fund would be more convenient for me because once you establish an account at $3,000, then you can put in small amounts periodically. Whereas with ETF, you have to buy whole shares. I'm not aware of being able to purchase partial shares through Vanguard. You've commonly said that tax advantage is better for the ETFs, and I'm just not actually seeing how that is much difference between VSIAX and VBR. Just would like your thoughts on this. I appreciate your time. Y'all have a great day.
Well, Gates, thanks for the call. The ETF should be slightly less taxable than the mutual fund, and I'll explain why. But it's not going to be dramatic. Not going to be dramatic. So we're getting into a little teeny tiny issue that may be not worth bothering with. If it's easier for you to get in the fund, although what's the share price? The share price for the VBR is like $170, somewhere around there. But here's where the difference lies. When the Vanguard Small Cap Value Mutual Fund, not the ETF, which is the VT, no, which one was it again? Vanguard. Hold on. I lost it. I had it here. Small Cap Value. There we go. I don't know why it went off my page. VSIAX. When VSIAX sells a position in a particular stock because it makes up too much of the portfolio, whatever the reason might be, and they sell that stock at a profit, they must distribute that profit to shareholders who will then show it as a taxable long or short-term capital gain on their tax statements they get every year. So on the VT, though, when they sell, everything happens internally, and that does not have to be distributed. That can get reinvested within the ETF. It stays in the warehouse, the ETF home. It doesn't leave. It's just a slight tax difference. So you will not on the ETF have distributed capital gains on which you have to pay taxes. All of the accrued capital gains will be taxable when you sell in the future, but it eliminates those little dribs and drabs of short-term gains along the way. Other than that, you're not going to see a hill of beans of difference between the two. That's it. But it is a difference. And for someone in a high bracket with lots of money invested, it might make a difference. A little. It's not big. Thank you so much. I appreciate you asking the question, and I hope that helped. 855-935-TALK is our phone number. Remember, you can send questions in by calling that number or by sending them in at talkingrealmoney.com. But next, we take a call from the phone.
Well, I have a lot of money in Vanguard, and therefore I have an advisor in Vanguard. But I have also a lot of money that I consider to be my safe money outside of the stock market. And I feel that I really need some advice on what to do with all that money outside of the market. But I'm not quite satisfied with the availability as well as the advice that I get from my Vanguard advisor about all these other issues. Maybe his job is more concerned with just the money I have in Vanguard. So maybe I need an outside advisor also. So that's my question. Should I try to get another advisor? Thank you.
Well, this is one of the downsides to the Vanguard personal advisor services. They're good services as far as they go, and that is advising you as to your account at Vanguard. But you only pay 0.3% a year for that. So you got to know that when you're paying that little, that your service is going to be limited. A full service fee-only advisor who charges 1% per year, which we think is probably about right, up to 1.25% maybe a year. You're going to pay more in fees every year, but you're going to get a broader suite of services. You're going to get advice for those assets that are held away, is what it's called, held away somewhere else, where the advisor doesn't get paid for those, but they advise on those. So you see, if you're paying someone 1% per year to advise on your investments, but they're also helping advise you on, $1 million that's held away, technically you're only paying about 0.5% for all the assets. Plus, you're going to get more in the way of you're not going to get tax preparation, but tax advice, planning advice, withdrawal advice, portfolio changes, and working the pieces together. You see, that's the thing, is that all of the disparate pieces need to work as one whole. And that's what the huge advantage is to a fee-only 100% fiduciary advisor who's full service, not somebody from Vanguard or somebody from one of the brokerage firms, because they're going to limit the advice in some cases. Some are really broad, but in most cases, like Vanguard's, they limit the service. So while the Vanguard advice is great for the Vanguard account, if you have a far more complex portfolio, financial life, you probably need to shop for a really good fee-only advisor. And we've got great resources to help you do that. Of course, we are one, but we're not telling you we're the only one. We give you the names of others who we think do a good job, who we think should do a good job, because we think they follow the same belief system that we have and who charge fair fees. And you can find all kinds of good advice on finding another, but I would not have both another advisor and the Vanguard advisor. I would let your new advisor consolidate the accounts that are consolidatable, including the Vanguard one, which they can do at no cost to you. So go to talkingrealmoney.com/help, talkingrealmoney.com/HELP, and read some of the stuff there. I think it'll help. Thanks for the call. We appreciate it. 855-935-TALK is our phone number. And let's do one more question, shall we? Phone question versus the other.
Hello, Don and Tom. Dr. P here from King of Prussia, Pennsylvania. It's my first time leaving a question. I found your podcast through Paul Merriman in early 2021, and I've been listening since. Enjoy you guys very much. One thing I do appreciate is you try to keep investing simple, and along those lines, here's my question. You have recommended VT, the Total World Stock ETF Fund, many, many times. And I see this has over 9,000 holdings and gets you to about a 60-40 split U.S. to international. I'm thinking it might be better to use two funds, VTI, Total Stock Market U.S., and then VXUS, Total International Stock Market. So combined, these two funds have almost 12,000 in holdings. So I wanted to ask you, do you think this is an improvement over using just VT? The thinking is it's only a two-fund combination, so it still allows for simplicity. So just wondering what your thoughts are on the one total market, world market fund versus the two funds. Thank you. Appreciate it. Bye-bye.
Thank you, Doc. Hey, we only suggest VT, one, because it's really simple. Really, really ultimately simple. For somebody who's just getting started, putting a couple $100 a month away, just do VT. Just do VT. Because it's easy to do. You can do it through any brokerage account, anywhere, with little or no fee, hopefully no fee at the discounters. So it is sheer simplicity. If we were doing this for us, we would make the process far more complicated. Matter of fact, my portfolio is far more complicated than that. I've got emerging markets and small cap value and all this other stuff. However, just making it one step more complicated isn't making it crazy. As a matter of fact, if you go to talkingrealmoney.com, and I'm going to do that right now, right along with you, and you scroll down the page to popular show topics, you will see 3 funds at 3 groups. There's a story. And if you look through those, you'll go, oh, look, we suggest Vanguard Total Stock. See, now these were funds. The Vanguard Total Stock Market Index, the Vanguard Total International Stock Index, and then the Balanced Fund for Bonds. So absolutely, go ahead and use VTI and VXUS, because then you can get closer to what the numbers actually are. And you're right, you do get more diversification with the 2 portfolios. They clip a little off at VT. So by all means, the only complication is now every year you probably need to rebalance. For example, after last year, the VTI did better than VXUS, which would mean you would be selling off some of your VTI, which had done well. So you're going to have to sell some of your loser to buy, or sell some of your winner to buy some of the loser. And that's hard for a lot of people. If you can do it, it's not that hard, then I think you'd probably be better off long term. You should have a slightly lower level of volatility. Thank you so much. Thanks for the question. Thank you all for your great questions. Thank you all for listening to Talking Real Money. Thank you all for telling people about Talking Real Money. And if you get a chance, tell some more people. Go to Apple Podcasts. I know some of you don't use them, but it really, really helps. I'm trying to get our ratings up. See, when I go to the top of the charts at Apple Podcasts and go under, we're now all lumped under business. It's a terrible thing. They lumped everybody under business. So the trick is to get into the top 200 of business. Now, we've been there, but we've dropped out. Like I go down here to 200. I mean, is this a business podcast, really? Style Your Mind. I guess. Eating While Broke. But see, there's so many podcasts popping up. They're pushing us down. So help. Go to Apple Podcasts and it's not subscribe anymore. What is it? Let's see. It's called follow. And for some reason, that's a big deal in their algorithm. Just hit the follow. Let's see. Talking Real Money. Yeah. Double checking. Oh, there we are. Look at our little ugly mugs. Yeah, there's a follow button over on the right. You hit follow, and then you're following it. It gets a little check mark. And also from there, you can share the show. You can also share individual episodes with the little 3-dot thing that you like a lot. You can share it all kinds of ways with individual people, with your mail. You can do it on Facebook or whatever. And then at the further down, the other thing that's nice is when you leave a review, particularly if you like us. Except for I've discovered you can't be on talk. I knew this for years. You can't be on any kind of a talk radio service without making people mad. We do occasionally, but most of you are happy. Thanks so much. I'm going to go away now in my Friday. Well, I have to edit this thing, so take care of yourselves. We'll talk soon. Saturday, call us live between 3 and 5 Eastern, noon to 2 Pacific at 855-935-TALK when we talk on Como Radio. That becomes a podcast next week. Take good care. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?